In this video, we will talk about Ocugen, the company itself, the current market conditions, and if you should buy the shares. Ocugen is a pharmaceutical company based in Pennsylvania. It is a startup with relatively high risk and reward. At one point in time, its stock price was trading well above $100. However, in 2018, its main product at the time, NeoCart, failed the phase 3 trials, causing the stock price to plummet as a result. Since then, the stock had a few years on a decline, before recently bouncing back. The fundamental reason of this recent rebound is because an Indian pharmaceutical giant, Bharat Pharmaceuticals, is currently developing its own vaccine and has granted Ocugen the right to sell the vaccine in the United States, assuming it is authorized by the authorities. This event has given Ocugen its recent stock market performance, jumping from a nearly penny stock position to around $10. With that being said, let's take a closer look to Ocugen and see what kind of company it really is. In its financial statements, the first news are encouraging. The company has more cash reserves and less short-term debts than previous period. This means that the company is better equipped to face its immediate obligations. When we look at the whole picture, and especially the notes, we see that the situation is murkier. Ocugen does not have enough operating income to support its research operations, and relies on equity offering to raise capital. In other words, it is currently financed by selling its own shares. Every year ends with the possible scenario that the next year may be its last one, because it does not have enough cash to continue. If it does not manage to raise enough money for any possible reason, then the company may be insolvent. Ever since the failure of NeoCart back in 2018, Ocugen has been in a tricky financial situation ever since. The recent news have been positive for Ocugen, but it does not mean that its financial health has improved by that much. If anything, the company may now raise more capital this year by selling the equity, assuming that the stock price maintains its current levels or even increases. The current valuation of Ocugen is almost entirely dependent on the outcome of this new vaccine, which is going through phase 3 tests. If it is authorized, this could indeed be a very positive news for the company. Its stock price can go to much higher levels to where it is now, and this has happened to so many other companies in recent months. The ones that immediately come to my mind are Novavax and Biogenic Genomics. When we look at the institutional buyers, the trend is clearly favoring towards buying the shares. There is an obvious indication that institutions are interested in Ocugen. Many household names are participating, among which are Citadel, BlackRock, Vanguard, and JP Morgan Chase. Beyond the obvious potential upside, I think that another reason why a financial institution chose this moment to buy in is also because the current price point. From a perspective of 5 years and longer, the stock price is at a very low point, and entering in the stock at this point is often a smart move, because although no one can predict the future itself, the downside is very limited and even minimized. Getting in Ocugen at this price point provides buyer the maximum probability of eventually earning a profit. Before we move on to my recommendations, if you like my content, please like, comment, subscribe, and check out my channel for more stock analysis videos. My recommendation is to buy the stock if you plan to trade the swings and especially the hype around the test results. In fact, I would say that the stock is a nice choice for those who felt comfortable buying and holding workhorse shares a few months ago. Although the two companies are in two completely different sectors, their stock prices relied on something almost identical called news betting. Ocugen's stock price would skyrocket if the phase 3 test results are positive, but it would also plummet, just like Workhorse did after the news about USPS contract. There is also an extra layer of risk for Ocugen, and that is the sector it is in. Pharmaceutical companies are very reactive to test results and often live from year to year before discovering a product that can eventually be sold for constant cash inflows. Until then, they can only keep selling their own shares or borrow from the banks. For Ocugen, the risk of bankruptcy is relative, since the company has been able to survive with share prices much lower than the current level. Overall, I would say that Ocugen is a good stock to consider for risky and high-growth portion of your portfolio. As far as the maximum exposure is concerned, the allocation to Ocugen should be on the lower end of things, based on the statistics of how much institutional investors are willing to buy. The vast majority of them kept their participation in Ocugen below 0.1%. Of course, that is also because they manage so much fund that they cannot put in too much in a small cap company such as Ocugen. Nevertheless, I would say that the maximum exposure should be between 0.5% and 1% of your portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.